Welcome back. This morning it was announced durable goods orders rose 3.2% in March, beating estimates, but that was really only due to a very large increase in aircraft orders. I believe it was from Boeing. Now, again, durable goods are high price items that are designed to last more than 3 years. We think about things like appliances, cars and trucks, furniture. Also, a very large component is defense. The green line shows us manufacturing new orders. That's all durable goods put together. The yellow line is the S&P 500. We can see a fairly strong correlation, at least as of lately, where durable goods rise and so does the S&P 500. The durable goods order is watched because it's a barometer of the economy. When the economy is growing, more homes are built. That requires more appliances. Also, sales for automobiles, things of that nature. We can see during the dip of 2020, both the S&P 500 and durable goods went down very rapidly and then recovered nicely together. Now here we see durable goods in the manufacturing new orders. That's all durable goods. And then the yellow line is excluding transportation. Now it was excluding transportation was stronger earlier on. That's June of last year. But as of late, at least, there seems to be a stronger correlation. It's kind of funny how June, July of last year, I think we're going to look back and see that was a really big turning point in the charts and in the economy. The other day we were talking about what had occurred in June of last year was the beginning of the inverted bond markets. And that also triggered a lot of other changes within the charts that we see and a lot of other economic numbers. Now, the durable goods is shown here in green, and excluding defense is also shown in yellow. Very, very close correlation. There's very little change between the durable goods and durable goods excluding defense. It shows it's not a very this sector, the defense sector, does not have a very big impact, at least as of late. That's the yellow line here in this case is the defense sector alone. And that matches up pretty closely with the S&P 500. Earlier on the year, the S&P 500 was performing at a much stronger rate, but both lines have really kind of converged together. Here we see durable goods as far as its own personal consumption expenditure in yellow. Now, the PCE, again, is the inflationary report relating to durable goods, how much inflation is built into this number. And then the green line overall is the PCE, the standard inflation number that we watch. Inflation seems to impact the durable goods in the same way or in a very similar way that it impacts other areas of PCE, meaning inflation. Now, this is interesting. The green line shows us the S&P 500, which hit a top December 2021, has turned to the downside, and now it looks like we're heading again lower. This is on a month-over-month basis. Now, the yellow line is durable goods transportation, which has experienced a very nice pop to the upside, which is understandable because really the only reason why the durable goods order was good today, the result was good today, was because of that Boeing order, the transportation sector, or the transportation component of the durable goods order. So if you read the different news reports, they're actually quite negative. They have quite a negative stance on today's number, and that it's the weakness is masked by the Boeing order. But if you take that out, it actually shows a decline overall. And the next chart here really kind of shows the divergence between the two. The blue line is the durable goods order. The red line is Whirlpool, which is, obviously the publicly traded company that makes the appliances like washing machines, dishwashers, things of that nature. Whirlpool tracks pretty closely with the housing market, which again is something we talked about yesterday, how a lot of the housing numbers seem to have turned June of last year at the beginning of the inverted bond markets. Well, Whirlpool, we can see, is enjoying a precipitous decline to the downside, while the durable goods order seemingly is going up. But again, the durable goods order, at least today's report, is actually quite negative if you take into consideration it was driven by, in large part, the aircraft order. Take the aircraft order out of it, and we'd probably see a stronger correlation. So, point being is that we look at these economic numbers, but I think it's not always very accurate to look at them in a bubble, but rather to take a look at the stocks and the industries that are most closely linked to these economic numbers. So if we didn't know better, we'd look at this blue line and would say, well, it looks like it's trending higher. But at least as of lately, it's only trending higher because of one very specific part of that order, and it is not a reflection of the overall U.S. economy, at least as far as large appliances and automobiles, things that are made to last more than 3 years. These are major expenses. And by the way, it's also important to mention that these appliances and automobiles are financed oftentimes. And with higher interest rates, I think this sector is very sensitive to higher interest rates, and that could certainly weigh on this sector moving forward. So overall, it looks like a negative report, but not something that's really visible at the surface. We'll continue to watch this with many other numbers, and we'll be back shortly with another update. We look forward to seeing you back soon.